Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today's a little off. We're going to have the EIA show. So this week we're just going to do the EIA show and the frac spread show, and then next week we'll get back to EIA economy and frac spread. I was traveling to Florida to do at a conference where I had to speak. So, got to see some real life travel. It was interesting, and I'll talk about that as we get into segment 2. But just to kick it off, we're going to look at gasoline separately for the last time, because we finally had the catch up, if you will, from Colonial. Like, we kept saying that there was going to be this big catch up trade, that there was going to be this big miss, and that's where we had this past week. So when we look at gasoline, we had a build of over 7 million barrels, bringing us pretty much right back in line with the 5-year average. We're only 1.5 million off the 5-year. But then when you look at blending components, that's where we start to see this big jump again, where blending components was up 5.7 million, which is 1.3 million above the 5-year average. So you had this big catch-up trade. And as we've been saying, imports came through, up another 118,000 barrels to bring us back above a million. So we imported 1,050,000 barrels, which is 342,000 above the 5-year average, driven by Pad 3 and actually Pad 5. But when you look at Pad 1, even though it was down a little bit, we still were well above the 5-year average. Now, that is going to start to decline. And as that starts to decline, we're going to see this makeup where the U.S. is going to produce as much gasoline as possible, which is about 64 to 68%, when you think about the yield factor at the refiner. But we've already maxed out that top of the stack. So we're going to have to put in heavier crude to pick up some of that middle and lower the middle and lower stack. But that's also going to result in more product for some other things, just to get that residual push into not only just the gasoline, kerosene, but also that aromatic side, which is why the blending components already above the 5-year average is going to be a little something to try to manage as we go through the remainder of the driving season. But it also opens up the opportunity to import more gasoline, because you can import a little bit lower grade instead of trying to make it, then try to use some of that blending capacity. So this is going to be something to kind of manage in general. So when we look at what's coming over from Europe, so as things start to get back to normal or more normal within Europe, we're seeing some of that the spreads start to close down a little bit. So the arb is open depending on where you're coming from, but it's really starting to narrow, which has pulled some of the capacity in terms of the trade between us. So right now we're expecting about 1.6 million tons in June, and so far we have about 895,000 tons and that are on their way. Another 592 that's already essentially purchased, ready to go, with more behind it as we go through the remainder of June, which will be well below where we were last month, when you think how we were at about 3.54 million in April, and then we had something similar or a little bit higher really in May. So that's where we started off strong in June, because we had some of that residual from May. Because remember, when it leaves Europe, it's a 4 to 6 week time period in terms of when we normally see it. So we're still going to have that residual through June. And then as we get into July and then into August, we should start to see some of this normalize. Now, on the flip side, coming into Pad 5, or the West Coast, that's where we're going to continue to see more, as Asia is trying to push out more product and trying to balance their market a bit. So then when you look at the demand side, demand actually got a little bit weaker. But again, we normally see it weaken after Memorial Day, so there wasn't anything too crazy when we look at the demand structure. And now as we go back and when we look forward, that's where we start getting to that 8.9 million barrels a day that we think we're going to see. And something that we've been saying since March, that the weekdays are going to underperform, what I think expectations are and what 2019 was. And then weekends are going to outperform. But when you think about the split, that's going to lead to a net reduction versus, what is seasonally normal. And now when you look at pad 3, we're right back to the highs, not right back to the, let's call it the 2021 highs, because we're not going to get back to those 2020, but you can see just how far away we are from the typical 5-year average, and just where we sit in terms of general storage. Because when you think about the split in general, we're 6.9 million above the 5-year in pad 3, where pad 1 has really closed the gap. Now it's only 2.5 million below the 5-year. And as we see those additional flows coming in from Europe, that'll close that gap even further. So then when you look at pad 1, here's what we're talking about, where now we're right back above to where we were even before colonial, because this is the whole aspect. Like where were we pre-colonial and then post? And here you can start to see that big pickup. And this is what we were saying, was that you were going to have refiners gear up at the same time you had colonial come back, and you already had all of these barrels that were coming over in terms of what you purchased on the import side. So this amalgamation of these 3 different capacities is going to keep that storage elevated, even as we get to that normalized demand cycle. So that's why we're going to see some of this. It's gonna get a little interesting, especially when you look at just when those imports come in, and when you look at what is already coming into the Atlantic Basin. When you consider what's coming from Asia and the Middle East, it's going to be interesting, because right now, instead of it essentially going right and heading into Europe, it could easily just turn left and then come into the U.S. And we're starting to see that more and more, just because even though Europe is getting back to normal to a large extent, they still have a significant amount of product and storage that they're trying to work through. So then when you look at the gasoline storage in general, this kind of gives you an idea of where we sit, where we had these counter-seasonal moves. And as we've been saying, we essentially just flatlined. And now we had this spike up. And now after we have the spike up, we still think that you're just going to start going sideways again as we start to get this balancing act between what's being produced, what's being imported, and then what's being pushed and moved through the system. So then when we look at the crude curve, we still are above 60 straight through 2023, and above 55 straight through 2025. So you can see that there is that capacity to continue to see activations, continue to see activity within the U.S. And now we had these U.S. lift sanctions on one Iranian oil official. So we're starting to see some movement in terms of what is happening with the U.S. and Iran, and that sent the market into a little tizzy, just because it wasn't really sure what to do. But again, we think the Iranian deal is not going to happen prior to their election, which is on the 16th. So it's just going to be something to watch, because how is this going to be reactionary? OPEC came out with its report. Iraq was well above what they reported. Saudi Arabia has now brought back 340,000 barrels a day, and we're starting to see this new supply come in. So we're going to talk about that a little bit today, and then more again tomorrow. So then when we look at COVID net changes, some of the components remain. India continues to have a steady decline, which is obviously net positive. Malaysia, but then on the other side, you have Malaysia, you have South Korea, you have Brazil. Better just to keep it with Asia first. So we have Japan, South Korea, Malaysia, Vietnam that are struggling right now in terms of those restrictions. And we kicked off, or Malaysia kicked off, a 14-day lockdown. And you can see that it's been fairly effective, but it's been a slower move down, and then you've had that kind of steady increase throughout the week. There's a good chance that we might get this extended. Now, Japan, which is supposed to be holding the Olympics, are talking about lifting the emergency a little bit earlier on the 21st. So again, there's a lot of things that keep happening that we're watching, as the UK has had a small uptick because the Indian variant has been moving through pockets. So it's just that's going to be something to watch, because so far it appears as though if you're vaccinated, you either won't get it or you'll have a very mild version of it, which again is that kind of the goal of that vaccine, to try to limit that. So we don't think that there's going to be this renewed, interest in terms of lockdowns or whatnot, but it could deter some consumer activity, but we don't think it'll do all that much. But now in the Latin American side, we continue to see a lot of pressure in Latin America. Things continue to remain really uncontrolled at this point, just based on where some of these numbers are, which is why we continue to see a very big reduction in demand, which is also pushing products in different directions. But we'll talk about that more in segment 3. So then when we look at the crude oil draw, so right now, and this is something that we've always done, we want to look at crude and refined products. It's not one or the other, but we always look at both, understanding how they interact with each other. So we had a draw of 5.24 million barrels. Then once we factor in the SPR, which pulled about a little over 1 million out of the SPR to get sold into the market. So the net drawdown was 6.59 million. Now, the one big thing that we keep talking about is what's happening in pad 3, because when we look at pad 1, pad 5, it's fairly stable. We're not having huge draws, we're not having big builds. It's really just pad 3 trying to work through that excess capacity to allow for those imports, because we do see a big jump in imports that will be coming in and really start in the 4th week of June, or really the end of June, and move into July, because we did have a big increase in refinery utilization rates, well above our expectations, but that's also going to put more product into the market. So we need to see that demand side pick up, or we're just going to take oil and just turn it into a lot of product that sits in a tank. So you're just taking storage from one and putting it into storage of the other. So then when we go abroad, this is something where we had a nice draw out of Japan. We had a little bit of a drawdown out of the US. We had a build in the ARA, but that has now flipped. So stockpiles fell to 6.4 million, which was to 654 million total. But when you look at where we've been working between this 650 and 665 number, every time we come down, then we have something that offsets it, because we're not really able to work through this excess, because not only do we have a continuous flow of new oil coming into the market, we also have a big excess of offshore storage. And that's where, when we look at what's happening in Asia continues to have a big build. Now, this is an old chart. We'll have a new chart in segment 3 where we break it down, and we've had another big spike up in storage, especially in Asia, which is moving much well above that 2016 high, and kind of not really obviously moving with 2020, because that would be insane, but moving higher instead of lower. Now, when we look at what's happening with teapots and how they're really cracking down on them running above their quotas, this is going to take a key buyer out of the market, or at least limit, because we were supposed to get quotas already, and we still haven't gotten the new quotas for the teapots, which again could kind of adjust the way some of these flows go throughout the system. Now, when we look at activity, so North America, rest of Asia, and I should say Americas and rest of Asia, continue to be, essentially flatlined. Europe has had a very steady growth. China, now this has stopped picking up. China, just because China, they're trying to hide what's going on. So when we talk in the Econ show, especially segment 5, where we go very deep into consumer behavior, activity, and that's where we continue to see a slowdown in general. Now, it's not a slowdown to the point where we're going to be the rest of Asia, but it's something where it's about 10% off of normal. Still better, but again, they've also been open the longest, and yet they still struggle to get into some sort of normalcy. So then when we look at the general crude, so we're right where we need to be, where we're having kind of those steady declines, which is, again, seasonally normal. We typically see this right now. So that's why it's always important to understand rate of change, because if you're drawing, we put a ton into storage, and then we drew it down, but how fast are we drawing it down? And that's the key, and it still remains fairly slow given the amount that we're in storage. So then when we look at pad 3, this is what we've been talking about. They're so elevated that they're still above even the low point that was achieved in 2021, which was in Feb, because we had that big build. Obviously, you had the Texas freeze off, you had the Colonial Pipeline. So a lot of things happened, and we still have yet to get back to those lows, which again is speaking more to the rise in production within the U.S. As we keep talking about, we're now at about 11.2 million, and that drop last week from 11 to 10.8 was offshore maintenance. Now, the 11 million that they keep quoting is a rig model. They used rigs to calculate what is happening in the U.S., and we're using the frac spread count because, again, that gets you much closer to that end point, which is why we think that we're higher than 11 and closer to 11.2 as we continue to see some of these different components. So again, these are important things that we keep looking at and you're seeing it here where we're not getting back down to where we were in 2021 in Feb, because we do have more production, we have more imports, and again, that's keeping us elevated and not kind of normalizing us at this point in time. So then when we look at Cushing, as we were saying, it was, again, just going flat. There was a little bit of a build, which Cushing had a build of 160,000 barrels, and that puts us only 7.1 million below the 5-year average. And you can see it's those, as we go sideways, it's going to, instead of seeing those steady drawdowns, it just means that against the average, it's going to become an easier and easier comp as we kind of just sit in this, let's say plus 100, plus 500,000, and that's where we're going to see, because there's going to be a big hit to exports, which we'll talk about in segment 3, just because the spreads really aren't incentivized to take U.S. crude. They'd rather take something else, especially given that the WTI versus Dubai spread is now positive, which just means that you take Dubai 10 out of 10 times versus trying to take something from the U.S. So then when we look at imports had a big spike of over 1 million barrels a day. It's still well off the 5-year average, which I think is important to appreciate it, and that's really driven purely by Pad 3. So Pad 2 had a big spike of 668,000, which is what we were saying last week, that we were going to get this big makeup number, if you will, and Pad 3 had a pickup of 332,000, but still well off normal, which is what we're seeing starting to flip, where we're going to start to see those imports coming through. So when we talk about that growth in imports, as we look into the end of June, it's really going to be based on Pad 3 and, more importantly, Pad 5 as we start to see some of those movements, because even though Pad 5 was down of 55,000 barrels, it's still right in line with the 5-year average. And again, that's where we start to see these movements, is all of that flow coming from into Pad 3 and into Pad 5, especially because the West Coast has been picking up some of that spare cargoes coming out of Russia in the Pacific. So when we look at crude oil runs, we had that big spike in up 2.6%. So we were thinking that we were going to stay around this 88, 89, and even see a little bit of a drop to 87. Instead, we went right up to 91.3%. And it just shows that we're starting a little bit earlier. So we typically get here, do we normally get to 91% in June. We just thought that there was going to be a little bit of a slowdown as refiners tried to pull more from storage, not trying to ramp up, but here we are ramping up and putting a lot of product into storage. So when we look at implied demand, now these numbers are what we were expecting last week. So that's why we were saying that instead of going from, let's just take gasoline for an example. Instead of going from let's call it to 8.9 to 9.1, we thought we were going to go up and then have that drop to about 8.1, and instead we had 2 moves up, and then we had 1 half move down, and now that inconsistency means that we're going to have one more number that's a little bit below, I think, where we're going to be in general. And because we still think that we're going to shake out closer to that 8.99 million when we look at gasoline. And the same can be said for the others, because distillate, jet, all of that moves through the Colonial Pipeline. So you had that reset. But last week and the week before, as we said, there were still five states that had close to 20% of their gas stations that were still out of product. And again, that's that movement from, that supply chain as to where is it in the supply chain and where is it being calculated. And that has finally moved through the system. Now we're going to start to see a pick back up, and we'll start to get some sort of normalcy overall. Propane is one that is going to continue to kind of flounder back and forth. Exports will remain robust, but again, local demand typically drops down, and that's going to push more into storage, which we've already started to see. Then when we look at what's in floating storage in the U.S., we pulled a lot of this off the water. Now we're going to have more showing up. It's just going to be timing as to when does it show up. But we do think that we will take out these highs that we've had in May, and we're going to work our way closer towards the 5-year average. Now, not getting to the 5-year average, but it's also important to understand that we normally see an increase. When you look at that 5-year dotted line, we normally have an increase during this period. So it's not crazy to see that, and it won't by any means get back to that level. But in order to get to maintain that 91, 92, 93%, it's going to be on the back of heavier oil, which we're going to have to import. So then when we look at imports, that's why this, we think, is going to continue to trend higher. Now, again, just because of timing, just because of when things came on and off, this could dip back down a bit, but we still think that we're going to end up in that bottom of the cloud in general. So then when we look at pad 2, this is that big makeup number. We're now broke back out above, the seasonally adjusted highs. It'll come back down, but it's still going to remain above that 5-year average. That's something that we think will remain kind of in this level, but within the cloud, but still remain robust as pad 2 refiners remain very active. And this gives you an idea. Looking over the last 29 years, you can see that obviously we normally have an increase, but the rate of change has really picked up. And that's been a bigger component in terms of kind of that run up into and getting much closer to what is normal. It's still about, let's call it 2 percentage points off of normal, but getting very close to that capacity. And that's where we continue to see, what comes next. We think gasoline and those product implied demands, that will normalize something closer to 14.7, not what we're going to talk about it in the beginning of segment 2. But it's again that divergence between what is happening, what is real, and then what is the data saying, because prices continue to go higher. There's a lot of stress on the consumer, and those are things that will start to weaken some of that expected demand that I think is really looked at in terms of what the summer is going to be as refiners ramp up, as we continue to see imports, and that's going to be one of those things that we'll talk about as we go through segment 2.